Welcome to my presentation of AIXTRON's first 9 months of 2023 and third quarter 2023 results. I will start with an overview of the highlights of the quarter and then give you some details on our financial figures. Finally, I will give you an update on the development of our business and our full year guidance. So let's get started. Order intake in Q2 2023 was 118 million euros. Just like we have seen it in the past years, Q3 was again lower than Q2. However, we expect to report very strong orders in Q4 and are therefore well on track to realize our full year guidance, all backed up by specific customer projects. The demand for wide bandgap power electronics again drove our orders this quarter. With GaN power having been slightly stronger than SiC power in Q3, our latest member of the G10 family of products, the G10 GaN, was launched in September and perfectly complements our G10 SiC as well as our G10 ASP. Our all-new product portfolio is being greatly received by our customers. Our Q2 2023 revenues of 165 million euros were up 86% year-on-year, reflecting the high demand for our systems. Revenue-wise, we are also well on track to achieve our annual guidance. The process of issuing export licenses is continuing to work, but generally takes longer than in the past, which we believe will be improving again sometimes later. Overall, we continue to see strong demand from our customers without any sign of structural weakness. Our equipment order backlog remains to be very solid at 368 million euros. Now let's dive a little bit deeper into our Q3 2023 numbers. Let me start with the financial highlights of our income statement on slide 3. As just mentioned, orders were lower this quarter, just like the years before. Important to notice, though, that we remain well on track to achieve our annual guidance with a very strong Q4 ahead of us. This underpins our view on continuous strong demand from our customers. Revenues at 165 million were up, as I said, 86% compared to 89 million last year, and we are well on track to achieve our annual guidance here as well. Gross profit in Q3 2023 was at 76 million euros, up 94% year-on-year. EBIT for the quarter was at 45 million, up 180%, and net profit at 40 million, more than doubled year-on-year. Gross margin was at 46% compared to 44% the year before, driven by an improved product mix. OpEx in the quarter went up to 31 million euros, predominantly driven by higher R&D spending compared to the previous year. Now to our balance sheet on slide 4. Inventories at the end of September increased to 381 million euros from 224 million at the end of 2022, which was mainly due to us preparing for the very high expected shipments in the coming quarters. Trade receivables at the end of September were 107 million, compared to 120 million at the end of 2022, mainly being a result of the recent business volumes in comparison to the very high business volumes at the end of 2022. The advance payments received from customers at quarter end were 125 million, representing about 34% of order backlog, like in the last quarter. Our cash, including other current financial assets, as of September 30th, 2023, decreased to 210 million euros from 325 million as of December 31st, 2022. This was mainly due to our inventory buildup in combination with our dividend payment of 35 million euros earlier this year. Out of our quarter-end cash balance, 133 million were invested into funds where we follow a very conservative diversification strategy. Just a quick word on our free cash flow on the next slide before I give you an update on our latest product generation. Free cash flow in the first 9 months was negative 82 million compared to 20 million last year. This was also due to the previously mentioned buildup of inventories in preparation for the strong output in the quarters to come. Before giving you some more details on our reiterated guidance for 2023, I would like to share with you some highlights on our new tool generation. As stated in the very beginning, we continue to see very strong momentum for our products. This is also owed to the fact that we now have our new generation of tools out in the market and those tools are being very well received by our customers. The G10 family of products marks a very important milestone on our growth path. All members of the G10 family offer a significant step up in terms of performance, both particle performance and uniformity performance. At the same time, these products offer a step forward in terms of productivity, that is in wafer output per month and in terms of wafer output per clean room area. This allows our customers to realize their volume ramp with the most efficient tools for high volume manufacturing. With that, our customers can address more and more market segments with compound semiconductors, be it in the area of power electronics or in the area of optoelectronics and displays. Most recently, we have launched our G10 GaN as the successor of the market-leading G5 Plus tool. The G10 GaN has been designed to support the high volume ramp of GaN power electronics. The G10 GaN allows the separation of the support infrastructure from the process-relevant parts of the equipment, which means that the pumps and power supplies can be located in a gray room underneath the tool, whereas only the process-critical components will have to be situated in the clean room. With this, 3 process modules can be attached to one wafer handler, such that the G10 GaN can offer more than 2 times the wafer output per clean room space. In addition, the G10 GaN offers big steps forward in terms of uniformity and particle performance. We have further refined the carrier design and temperature control. Based on this, we can achieve a large improvement of uniformity in thickness and composition for the critical layers. Supported by these improvements, we get very strong demand from customers for the G10 GaN. Most of our existing high-volume customers have switched from the G5 to the G10 GaN as soon as the new tool became available for them. Such already next year, the year right after the launch, we expect more than 50% of our GaN tool shipments to be the G10 GaN series already. With the G10 GaN, we are also convincing new customers that have not been producing on Planetary technology yet to choose AIXTRON as their equipment vendor. For the G10 SiC, our new tool for the silicon carbide material system, which we have launched last year, we received a continuous flow of orders. From all our existing high-volume customers, we have received repeat orders in the past quarters, and we have strengthened our competitive position by having made significant progress in terms of uniformity performance. We are now achieving uniformities on par, and in some cases even better than single wafer tools. For 200 millimeter wafer sizes, we had reached that already earlier. For 150 millimeter wafer sizes, we have completely closed the uniformity gap in the past quarter. Based on this, we can now fully focus on the advantages of our Planetary reactor on productivity and cost. The batch offers inherent advantages in these 2 dimensions, and we continue to win new accounts for our technology. This will then eventually turn into revenues in the quarters to come. Last but not least, with our G10 ASP, we are winning new customers, and we are seeing customers switching over from the proven G4 platform to our new G10. With this tool, our customers can produce even the most sophisticated lasers in volume, be it for optical datacom or for upcoming LiDAR applications. They can also produce high-quality micro-LEDs for future display applications with our G10 ASP. The platform is the only fully automated MOCVD systems for advanced gallium arsenide and indium phosphide-based materials. It comes with in-situ cleaning and a SMIF interface, which is common in highly automated production environments, both enabling ultra-low defect epitaxial layers that are needed for the volume manufacturing of these applications at lowest cost. Overall, we're very happy with the market traction of our G10 series. We have invested significant amounts of R&D, and as of today, we expect that the return on invest is coming even faster and stronger than expected before. This confirms our strong focus on technology and innovation, which we will also continue in the years to come. In keeping with this, in May of this year, we have announced that we will be expanding our facility at AIXTRON with our new innovation center. Last quarter, we have completed the planning for building and facilities. We have received all building permits and have signed up the contractors. Construction has recently started with groundwork ongoing. In this place, I would like to comment briefly on the export situation. AIXTRON is not affected by the tightened export controls that the US government has issued recently. With this, our business with China will continue unchanged. However, AIXTRON, together with other German equipment and industrial companies, is still affected by the slow speed of export license processing within the BAFA. We hear from the BAFA itself and also from many other exporting companies in Germany that a temporary staffing bottleneck is the root cause for that. And we hear that the BAFA is working on resolving this. Again, this is a purely operational topic, completely unrelated to the China export restrictions of the US, just for clarification. With that, let me now give you the update on our reiterated full-year guidance for 2023 on slide 7. As said before, we continue to see strong momentum for our products, giving us the confidence of being able to fully reach our upgraded annual guidance. On all other metrics, we are also fully on track, which is why we reiterated our guidance, which is as follows. We expect total orders for the full year in a range between 620 million euros and 700 million euros. Our total revenues are expected to range between 600 million and 660 million. We have not narrowed the ranges of orders or revenues due to the unpredictable factor of the exact timing of export licenses and also of some customer projects, as we explained earlier in this call. We continue to expect a gross margin of around 45% and an EBIT margin in a range of 25 to 27%. With that, I will close today's presentation of our Q3 highlights and numbers. If you are interested in the Q&As of our Q3 2023 presentation, then please check out our website under the section of our conference calls. Thank you very much for your interest and bye-bye.